Today we're answering a big question. Is it possible to time the market using the volatility index, aka VIX, otherwise known as the fear index? In today's video, I'm going to share with you some studies I did going back to 1990 to see if indeed it was possible to increase your returns while lowering your risk. In this video, we're going to talk about it.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
This episode was sparked by a question I got from David. He says, why don't you do a video about the VIX fear factor? It just dropped to 14, and this was 8 days ago, so that is about September 21st, 2023. So he brings up the investment strategy of selling the S&P 500 when the VIX is around 14 and buying when the VIX is above 23. I thought this was very interesting and definitely worth diving more into. So we're going to first start out with what is the VIX, and then at the end of the video, we're going to put it all together and actually backtest what would have happened if you would have followed David's strategy relative to just simply buying and holding. For those of you that are not aware of what the VIX is, it is basically an index that measures what the market's current expectations of future volatility are, and that's derived by looking at the options market. This great financial crisis resulted in stocks falling 50% top to bottom, and you can see that the VIX index absolutely soared. So just looking at this, you'd say, you know, it'd be a pretty good buying opportunity if anytime the VIX, would exceed, say, 40 or 30 or 20 or 50, to buy stocks whenever that would happen. This was a very good buying opportunity. And if you look to 2020, when the COVID-19 lockdowns happened, you see the same thing. The VIX index again hit over 50. This represented a fantastic time to buy stocks. And conversely, what happens when the fear factor is low or expected volatility is low? Well, you might look at this and say, hey, look, whenever volatility got to about 10, that was a pretty good time to sell stocks, right? That was about 2007, right before the great financial crisis started. So that's why I sought to put it to the test and get some actual data behind it. So this is the result if you look back to 1990, investing $1,000 at the start in each of these three strategies. So if you would hold stocks only whenever the VIX is greater than 23 and hold cash in all other occasions, a $1,000 investment grew to $7,562. If you would only invest whenever the VIX is greater than 14 and go to cash whenever the market is basically expecting very low volatility or fear is generally low, 1,000 grew to 9,891. And then finally, just remaining fully invested regardless of what the VIX did, grew to 13,493. And one thing I also looked at is what would be the maximum drawdown over any rolling 12-month period in each of these strategies. So in the first one, investing all the time, the maximum drawdown over 12 months was negative 41.4. The exact same drawdown happened with the 14 plus VIX strategy. But then once you got into the higher numbers, so this was the 23 plus VIX strategy, this would have saved you a little bit of heartache in 2008 and 9. Instead of dropping 41% over the worst rolling 12-month period, this was only 29%. However, in exchange for that lower volatility, you had to give up basically 2 times your returns. So volatility about 25% lower, returns half as much. Doesn't seem like a terribly great trade-off to me. One other thing to keep in mind is that this strategy does not include transaction costs from buying and selling. It doesn't include taxes from buying and selling. So overall, I would say that using the VIX as a timing mechanism does not appear to work in history, does not appear to provide superior risk-adjusted performance. So it seems like the best thing to do is just simply buy and hold stocks, regardless of what the VIX indicator seems to suggest. Shout out to David for the question. Also shout out to David for supporting my work via YouTube. For all YouTube members and Patreon supporters, I have posted a couple videos this month about the coffee can portfolio. We also did the Q&A session, and then I just published a video going through the 401k scorecard, which is basically a way for you to measure how the funds in your particular 401k fund stack up against each other. So be sure to check that out. I'll put links in the description down below if you're interested in supporting my work. Thanks for watching the video, and I will see you in the next one.